Holy fucking shit.
The trade desk, ticker symbol TTD, just reported earnings after the bell, and there is some very ugly price action going on, down 28% in the after hours. The stock going from $88 to $62 per share. Brutal. Net, if you include the whole day, the stock was down about 30%. And we're going to talk about why and ask and answer the question, is the trade desk a buy right now? But before we dive in, if you guys could please go ahead, like and subscribe. It really helps me out. Now, the trade desk is a technology company that provides a self-service platform for programmatic advertising. It helps advertisers plan, buy, and manage digital advertising campaigns across various channels. Essentially, they empower buyers of advertising to leverage data-driven insights to optimize their campaigns and reach their target audience effectively. The quarter was great, beating revenue estimates, growing 18%. The company also smashed its earnings expectations, beating non-GAAP earnings by a wide margin. However, GAAP earnings was less so of a beat, but non-GAAP earnings grew 25% on a year-over-year basis. Growth was driven by the CTV segment, retail media, and supply chain improvements. Now, the company's gross margins actually fell, and we'll talk about why that is, but this is not an encouraging sign and is one of the many reasons why the stock actually fell. We saw margin compression across the board in gross margins, net income margins, and even the adjusted EBITDA margins. Margins across the board fell, and that really just has to go with a whole range of things from competitive pressures as well as the cost of doing business. However, when you look at the nominal dollar figures, net income did actually grow to $90 million, again on a nominal basis, and adjusted EBITDA was $271 versus $242 for the quarter. So despite margin compression, because revenue grew 18%, we saw these figures go up naturally. Company's balance sheet is very healthy, $300 million in debt, $1.7 billion in cash. You love to see that. Now, so revenue grew 18%, and this is where the problem with the margins started. When you look at platform operations, essentially cost of goods sold, that actually increased 36%, essentially doubling the growth of revenue. And this is not good. When you see, platform operations or COGS go from 110 million to 150 million, this probably means a whole range of things. Inside the actual advertising buying, it's really an auction. So they're paying more for the ads. There's a bidding more. That's obviously going to benefit something like Meta, Google, or Amazon, maybe a company like Netflix. However, it's really going to hurt a company like the Trade Desk. At the same time, growth is moderating. This company was normally growing in that mid-20s rate region. It's now growing at a high teens clip. So we are seeing growth moderate, and that's also could be competitive pressures. And when you have, competitive pressures as well as a higher cost of doing business, that's how you're going to get gross margin compression. They did do really well in the actual operating expenses, only growing 17.8%, and they made some material improvements all in all. Look at general administrative expenses. That actually fell on a year-over-year basis, but net, all of the expenses grew 17.8% for the quarter. And as a result from that, you actually saw net income only increase 6%. And the company, because it's doing so well as a business, I guess, their income taxes are actually significantly higher. They provisioned $43 million versus $27 million last year, and that is a 34% growth. So all of this together is the reason why we only saw net income up 6% for the quarter, and that's why the stock is falling. It really has to do with the financial health of the company. Now, there's nothing wrong with the business. It's just that, competitive pressures and competitive dynamics at play, as well as taxes, are really eating into the overall profitability of the business, hence why the stock sold off. Now, you can see the company is an absolute growth machine. However, this is growth spend on the platform that has been sequentially increasing over the last 2 years from 24 to 25%. I do think we are going to see growth drop off in a significant way. We should see growth spend ticker off this year at about 18%. So nominally, you're still going to see growth spend increase, but the rate of that increase is going to decrease. And we started to see that in the guidance. Now, the guidance actually came in line with the street's expectation. This is roughly what the street were expecting. However, when you compare the growth on a quarter-over-quarter basis versus Q3 2024, you're looking at about 14% growth right here. And again, another moderation of growth from that quarter. So you're literally going from 22% last quarter to 18% this quarter to 14% next quarter, as you clearly see a deceleration in growth. And again, that largely has to do with competitive pressures. And then adjusted EBITDA margin still remaining roughly in line, growing in line with market expectations. And the thing is, if growth is moderating and a company's trading at 100 times EV to free cash flow in September, and still, even after the drop, a 60 times EV to free cash flow, your stock is way, way overvalued. The average S&P 500 company trades at 17 times. And that's why you're going to get these moves. If you don't come in and absolutely beat and wow the street, similarly to what Palantir did in their most recent earnings call and their most recent quarter, you're going to get sold off like this. And I think ultimately what we're seeing here is a multiple re-rate for the company. The street needs to reassess the growth profile for this company, and the adjustment's going to come in vicious price corrections like we saw with the trade desk. Something else that did hamper on sentiment, they got a new CFO. I thought the CFO was really qualified, but that could have hampered sentiment. But I don't really know if that really impacted the stock. I really think it was more to do with the financials, but they appointed a new CFO for those that actually want to know. Now, what is the thesis for the trade desk, right? It's very, very simple. Ad spending is a $935 billion market, and it's only going to get bigger. And by investing in Trade Desk, you have a company that wins more of the budget and is going to take a significant portion of that $935 billion in marketing and ad spending. And they're at the forefront to go ahead and do that. And that's ultimately the thesis. Ad spending budgets will continue to remain robust, particularly when it comes to social media, online TV, etc. And the trade desk is a way to play that and a way to extract value from that. But let's actually look at the valuation of the company and what are the returns we can expect. So if we plug in the trailing 12-month revenue right here, 2.6 billion, right? And let's say that grows at consensus estimates of 14% to 5.1 billion. And then the free cash flow margin going from 25 to 28%. That's roughly in line with consensus expectations. You should see free cash flow of 1.44 billion by 2029. And we're going to use a 30 EV to free cash flow multiple, which is, in my opinion, a lot. For the stock to get to this level at the current earnings, it would need to go down another 50%, like right now here today. But we're saying in 2029, using a 30 multiple, right? This is the returns we can expect. Now we're going to subtract the net debt, divide by shares outstanding. Now we're assuming shares are not going to increase or decrease. The company is buying back stock, and there was about share dilution last year of about 0.5%. So I'm assuming, by 2026, 27, they may even be decreasing their shares outstanding, but I'm just going to use a zero number. And by 2029, you're looking at a stock price of about $100. Current stock price is about $62, and that would represent about a 9.8% return over the next 5 years. And the fair value would be about $50. But this is such a hefty multiple. I think, closer to 20, maybe 25 would be better. And then this growth would moderate significantly. I think 30x is a really, really steep multiple, especially on like a free cash flow basis, on an EV to free cash flow multiple. 30 times is really, really expensive. I think Nvidia trades at like 34 times, right? And that's Nvidia, one of the widest moat companies in the world. So 30 times is a bit excessive, but if that's the case, that's how you can get a 10% return out of the trade desk. So is the trade desk a buy right now? Definitely not, especially as growth continues to moderate. Now, looking at the technical charts, the stock is going to open right here tomorrow at about the $62 mark. If we do get here, we are then back in a very, very clear downtrend. You could see that we made highs, an all-time high right here early on in the year. Then we had a massive move. We put in a low. We then put in a high and then a higher high right here, okay, along with a higher low. So you can see we are in an intermediate uptrend. However, if we go ahead and open at this level right here, we then would have broken this low, and that just means we put in a high, right? A lower high, and now putting in a lower low. If we open up at this level, it's very, very clear that the stock is now in a very, very clear downtrend. And ultimately, right, that probably opens up like the $40, $49 area right here, the fair value area. So look, if the stock gets to that $50 area, I would consider buying it. But even at $62, it seems a bit pricey. I think, anywhere $50 and below, that's when you can really start looking at the stock as an attractive play, looking 5, potentially 10 years up. But until then, the stock is not a buy. I love the business, not the price. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.